Hey everyone, it's Daniel here from etfs. Hope you're all doing well. So jobs. We got the non-farm payroll report on Friday. The number came in, wasn't that bad. I'll just read here real quickly for you how the numbers played out on Friday. But basically, the non-farm payrolls report expected number was around 239,000. The actual number came in 236,000, so slightly below, but not a big drop, right? We didn't see a negative number or anything like that. That people are expecting that jobs are going to get worse off because the recession is going to come in. We're seeing the layoffs. We heard about McDonald's cutting off the employees and tech companies and etc. But yet the job market in this report still is showing that we're still doing relatively okay. Now, the revisions from the previous month did move up higher, which was revised from 311,000 to 326,000, which, one would say that, okay, looking at these numbers previous month and this month, that there's no reason to be cutting rates all of a sudden that markets are expecting because the job market's doing fine, right? So when we look at the other parts, the participation rate has also slightly increased. We look at the unemployment rate, still at really good levels. Expected was 3.6%. We see the actual at 3.5, so better than expected. And if you look at the average hourly earnings month over month, came in line at 0.3%. The year over year number slightly down, but again in line. So overall, the jobs data is saying that, hey, everything's fine. And the reaction in bonds and stocks were just basically some selling that you had, and mostly in the bond market. And you had the yield curve basically flattening, basically pricing in that, hey, how can the Fed start cutting rates when the job market is still robust, right? When the unemployment rate is still at really low levels, 3.5%, right? How can the Fed start cutting? I mean, this would mean that the Fed should continue with its rate hike, which means that, hey, we could see a rate hike very possible in May, which people and traders are trying to guess how this rate hike is going to be played out. Are we going to get it in May or are we not? Right? When we look at the previous numbers like ISM that came out during that week, they were really weak. When you had the manufacturing sector basically showing you both the services and the non manufacturing services, the services component, non-services component, when you look at that, right, it still shows weakness in both the data, and it shows really strong contraction. However, the job market is still robust, which means that if we remember, the Fed has two main mandates, which is managing the job component, the unemployment rate, which is satisfied, great, check mark to that. But the other component, the other mandate that they have is inflation. That is yet to be solved. We still need to get to the 2% target. So if the jobs are doing well, then May rate hike, a rate hike in May is very possible. Now, can there be a pause? Of course, very likely we could see a pause after the May rate hike, or not, depending on what the Fed comes out with. We do have the Fed minutes this week, so it'll be very interesting to see and hear what the Fed has to say in those minutes. Do they mention anything about a pause? So we could see a rate hike in May and then maybe completely done and say, okay, the Fed says here we need a pause, we need to assess the situation because we're not sure how this is going to play out. We want to see the effects of all the tightening that we've been doing. Yet again, the job market is still robust. So does that mean that the Fed knows that, hey, after May, we're probably going to see these job numbers, non-farm payrolls numbers, get into negative territory? We will start to see the unemployment rate pick up. That is possible, but we will only know until it comes. And until then, we'll have to see, is the Fed pausing? Are they not? And is that considered a pivot? In my opinion, not really. It's a pivot once we start cutting rates. Now, can they go from hiking rates to cutting all of a sudden? Sure, if there's something that truly breaks. But nothing has broken, right? The banking sector, I said this in the previous videos as well. I said that, guess what? People are going to forget about the banking sector that's under pressure, right? They're going to think, oh, everything's fine and everything's okay. So if everything's fine and okay, we heard even Bullard say that, hey, the financial sector is fine, the banks are fine. Powell even said the same thing. So then what? Then what is they were again focusing on inflation. Bullard did that, Powell did that, and we're going to get the minutes and see what they have to say. Probably they're going to reiterate the same thing that what they've been saying all along, is that the banking sector is fine, your deposits are fine, we're focused on inflation. We want to bring it down. So they want to bring it down, and if they pause, then how long will they pause until they start cutting rates? And if, the answer to that question is that they could pause on average, they generally tend to pause around 6 months, 6 to maybe 8 months, unless something breaks earlier. And if something breaks earlier, then guess what? Yes, that is deflationary. That will bring inflation down. But if not, then you keep rates higher for longer. And we heard the Fed say this. We heard the Fed say that we don't know where our target is, where we're going, but we're going to keep rates higher for longer, which means that they want to create tightening conditions. They want to create some tightening in the market, so people are not, the banks are not lending that much, people are not borrowing that much, there's not much spending to try to bring inflation down. So it's going to be really interesting this week because we also get CPI, we get the minutes coming out from the Fed, and it'll be very interesting to see what they have to say and how CPI and inflation this week comes out and how it will pan out and what the probabilities will be like for the May meeting when it comes to rate hikes or a pause or even rate cuts, because the bond markets are expecting that we're going to see rate cuts very soon this year. And if we're going to see rate cuts very soon this year, that hints that something is about to completely collapse and break. This is not fear mongering, but it's just the reality of how the markets are pricing and looking at what is to come. Remember, the markets are forward looking, right? The stock market is forward looking. The bond market also is forward looking. They're looking at what's coming in, pricing in probabilities, right? The Fed doesn't really do that. The Fed more reacts, and I would say more the Fed follows the markets rather than the markets following the Fed. The Fed is always late to the table, while the markets are always forward thinking. The Fed is more looking like, okay, what's the data today? What's the data right now? I mean, of course, they understand the lags that are in the data, but they're looking at, okay, what's happening right now, right? What's the data telling us right now? What's the jobs report telling us right now? It's still strong. If inflation is still hot, then hey, we need to keep it tighter for longer until we have full evidence, because they don't want to run the mistake of cutting too early, which would then exacerbate and bring inflation higher. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.